Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to the Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree, Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. A lot of new investors have entered the market in recent years, which is one of the changes we've witnessed. According to Robinhood's most recent quarterly data, the number of funded accounts has doubled in the last year, and over 50% of its users are new to investing, according to their S1 filing. This is a positive trend since it suggests that more individuals are turning to stock market investing, which will surely benefit them greatly in the long term. However, the stock market is a difficult area to navigate, and beginners frequently make mistakes that appear counterintuitive. In this video, I've outlined 10 frequent mistakes that beginners make as well as how to avoid them. So let's get started. For the first mistake, well, it's about investing because the market is rising. This is a typical misconception since you should be excited when the market is going down, not when it's going up. Do you still remember that famous statement from Warren Buffett? Well, he says, be greedy when others are fearful and fearful when others are greedy. It's difficult to grasp at first, but just remember that when everyone is talking about the stock market and the market is simply moving up to new all-time highs, it's probably not a very good time to invest. You want the stock market to fall in the early stages of your investing career if you really want to make a lot of money in the long term. You want the market to plummet and the lowest possible starting point. As the saying goes, buy low, sell high. Thus, if you want to make a lot of money over a long period of time, pray the stock market falls tomorrow. In the long run, cheaper entry prices make a huge difference. Mistake number 2 is about purchasing a stock without first evaluating its intrinsic value. So remember that shares are not just pieces of paper. They reflect real ownership of a company. When you buy Apple shares, you're purchasing a piece of the company. You must know the value of Apple in order to determine if the shares are cheap or pricey. How would you sell things so well that the business generates a particular amount of cash flow at the end of the year? To determine whether you want to buy Apple at its present market cap or stock market value, you must first determine how much cash flow it generated last year and how much it will generate in the future. Just imagine. So let me ask you, are you willing to pay $1 million for a money printing machine that could print $1 every day? Would you be willing to pay $10,000 for it? Most likely not. But would you be willing to spend $50 on it? Of course, since you've made your money back in 50 days and may then print $1 per day for free for the rest of your life. When it comes to stocks, it's the exact same equation. So before you go out and buy the shares, be sure you know how much they're worth. Okay, now we'll go on to mistake number 3. The third mistake is investing in something because a friend purchased it. Just please don't do that because who knows what your friend knows. And even if they studied economics, finance, business, international relations, and everything related to finance and stocks, remember that the stocks that are great for them will not be the same as the stocks that are right for you. So you'll have different financial goals, different areas of interest and knowledge, and various investing timeframes in mind. They might want to day trade while you might want to invest for the long term. You both have different paths. Just don't copy your friend's techniques. Moreover, you're maybe aware of mistake number 4. Don't listen to stock advice at all. You may have seen some YouTube videos about these 3 stocks he or she's purchasing this month. Just don't invest in those stocks unless you've done your own research. If you hear a fund manager on CNBC talking about a stock, don't buy it just because they did. Consider this. What are you gonna do if your stock drops 30% in a single day? Is there a fundamental problem with the company? Should you sell or should you acquire the stock now that it's so cheap? You'll never know, and that's a dangerous place to be. So don't trust stock recommendations too easily. Then there's mistake number 5, which which is buying something you don't understand. You have to know what you own, Peter Lynch famously said.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
People love to own cutting-edge stuff that appears to be the next great thing, but it's also the things they have no knowledge about. If you like Big Macs but don't know anything about graphics cards, go into McDonald's instead of Nvidia. Simply follow and stick to companies that are relevant to your interests. Look for uncomplicated businesses. You'll have a much better investment experience if you do this. Now I'd like to discuss mistake number 6. Honestly, stock market traders don't make any money. They make money by teaching others how to trade, but when those traders fail, they open a YouTube channel to educate others on how to trade, and that's what makes them money. Thus, short-term stock trading does not function effectively, but you know it does. When you invest with a long-term view, you know that if you truly commit to staying in the market for more than 10 years, a lot of the stress of investing fades. What if the stock market just dropped 50%? What does it mean that my portfolio has dropped 60% in 3 weeks due to the banking system's collapse? Awesome, no problem. When you're devoted to long-term investing, you win when the market rises, but you also win when the market falls. Because if the market falls, you'll be given a once-in-a-lifetime opportunity to buy fantastic long-term investment prospects at cheaper costs. So keep strong and go long. For mistake number 7 in investing, this is about purchasing a business without a moat. You know that investing without a competitive edge is one of the cardinal sins. You know that buying a business without a competitive edge is gambling. Why? Well, because there's nothing in place to safeguard that company from its competitors. How do you even know that company will still exist in 10 years? You already know that investing in companies with a broad moat minimizes the risk of permanent capital loss, because they have an intrinsic advantage that protects them from their competitors. An example company that has a moat is Apple, because their products are similar to everyone else's except double the price. You might believe that, but there's a reason for that. They have a huge brand moat and have established a massive ecosystem, which is known as a switching mode. They have moats that protect their competitive position. Facebook has a massive network effect that no other social media firm can match. Another thing is that there are dozens of other cheaper cola drinks besides Coca-Cola, a big brand moat. Coke has a price 3 times higher than others. If you're going to invest in a stock, make sure it has a competitive advantage. Now on to mistake number 8. This one may be difficult to hear, but believing that you're an expert is a big mistake. There are only a few people who are experts in investing, and to be honest, those people actually wouldn't even call themselves experts. One of the disadvantages of the market we've been in for the past few years is that many people haven't yet experienced a significant loss. Because the truth is that if you bought stock in the last 5 years, you've almost certainly made money. And no doubt when you're sitting comfortably, it makes you feel like you've got this investing thing right. Don't become too complacent. Always go in believing you're missing something and assuming you're wrong, and you'll do much better next time and in the long run. Second to the last and number 9 mistake is something known as confirmation bias. This is the part when you seek out evidence supporting your theory and discard information that disproves it. Because we're all human, we're all susceptible to confirmation bias. However, we may identify that we are vulnerable to it and take steps to mitigate it so that it doesn't impact our investing. So how? To put it another way, we flip our investment hypotheses. If you have a hypothesis that the stock is good, compel yourself to write all the reasons why it could fail. The last investing mistake I'd like to mention is simply failing to keep up with the firm once you've made an investment. We do a lot of research to make sure we're ready to acquire anything, but after we do it, we often forget about it and don't keep up with it. If you're gonna buy a stock, you should stay up with what's going on since things change over time. Businesses change, rates of growth change, and customer preferences change, so make sure you read each quarterly report and be updated. Also, don't let it slip through your fingers since you already know what will happen if you don't pay attention. There might be something horrible that will happen to the company. Always keep an eye on what's going on, which is especially easy to do if you're sitting on a huge unrealized game. So don't allow your hard work to go to waste due to laziness. And there you have it. Those are the top 10 investing mistakes sometimes made by the beginners. Now that you know all of them, I suggest you write some of them and post them on your wall. And just always remember them. We'll probably make mistakes when we're investing, but let's educate ourselves and be prepared. I hope you learned something from today's video. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.